Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of May 29th. Well, first and foremost, I hope you had a good Memorial Day weekend and you took a moment this past weekend to honor those who have served our nation and are no longer with us. So turning to the financial markets, the debt ceiling talks have dominated the headlines over the past few weeks, and it looks like we have some potential positives in Washington. Do expect more news out of this over this week. Since we've talked so much about the debt ceiling crisis over the past two of these updates, let's come back to the other market headwind. Is the Fed likely to raise rates again or pause at their next meeting in June? As a reminder, the Fed since March of last year has been raising rates to slow inflation, but inflation remains uncomfortably above their 2% target. And at the same time, there's some clear signs that the economy is slowing pretty fast, maybe a potential recession on the horizon. Late last week, we saw core PCE inflation, which is a favorite inflation measure of the Fed, and personal spending, as you see here, came in both above expectations. If you take these together, this tells the market that inflation is still too high and the economy is strong enough to withstand more rate hikes by the Fed. No surprise, expectations for the Fed raising rates at their next meeting in June went from 17% to 64%. And this was to raise rates by 1/4%. Again, 17%, very low probability, to now 64% after those key reports. How about this week? What are we going to look at? Well, data to get a better perspective on Fed direction, we're watching two key reports. Thursday, we get the ISM Manufacturing Index. Remember, this is the first look at the May economy, and consensus expects a slight drop from 47.1 to 47. As a reminder, below 50 in manufacturing is considered a contraction. On Friday, we get the big report, the payroll report, and we're going to watch two data points within this report. Number one, non-farm payrolls. If you look at consensus expects a slowdown from 253,000 to 200,000, as you see here. Then hourly earnings are expected to slow from 0.5% to 0.4%. Our expectation, given the evidence of employment slowing a bit in survey data, given the fact that companies are easing on both borrowing and they're hunkering down given potential recession worries, we expect both payrolls and wage growth to come in lower than expected. So overall, the key takeaway this week, there's a lot going on around the debt ceiling, but you can't forget about the Fed as a market driver. The next Fed meeting is June 13th and 14th, and we will be watching all the data releases between now and then to get a better idea on the direction of inflation and the economy. If this week's data comes in higher than expected, this puts more pressure on the Fed to raise rates. If it comes in lower than expected, the Fed could pause at the next meeting. Thank you for listening. For more information, please follow us on Twitter at CeteraIM, and I will see you next week, and thank you.